Hi everyone. Hope all are well. And I presume my last session on what is valuation and what are the different types of valuation was useful for you guys to a certain extent. Now, my this video will talk about what are the various methodologies which currently are prevalent for understanding valuation. Now, the valuation is, primarily calculated on three main approaches, which is the income approach. Second is the market-based approach, and third is the asset-based approaches. Now, let's understand what is the income-based approach. One of the best methods for income-based approach is none other than DCF. DCF methodology is often called as the gold standard of intrinsic valuation. If you guys remember the last time I told you that intrinsic valuation is nothing but, the valuation where the asset, is valued basis on the future cash flows, on the capability which it has to generate those future cash flows, right? DCF actually stands for discounted cash flows, and it's a similar method of intrinsic valuation to understand what valuation is. Now, what exactly is a discounted cash flow analysis? This methodology actually calculates the value of the projected unlevered cash flows. Unlevered, I would rather say unlevered free cash flows. Now, what do you understand by the meaning of unlevered? Unlevered means where any leverage is not taken. It typically means there is no debt involved and there is no liability coming in on the payment of debt front to the shareholders. That is called as the unlevered free cash flows plus a terminal value. Now, why do we need to calculate a terminal value? Terminal value is calculated for any business because a business is always considered to be a growing concern, a going on concern. So it will never stop its activity. So after a certain period of time, a terminal value is calculated, which it means that no matter what, the business will always generate a value, assuming there is a terminal growth rate, a standard growth rate year on year after a certain period of time. Now, that certain period of time is always assumed to be the high growth period, right? Now, this DCF translates a company's projected operating performance into a single defensible enterprise value today. So basically, all the future cash flows which the business or the asset generates, those future cash flows are actually discounted. Now, what are they discounted on? They are discounted on the weighted average cost of capital. First, let's understand how the free cash flow to the firm is calculated. Now, free cash flow to the firm is calculated with the help of this formula, which is earning before interest and taxes multiplied into 1 minus the tax rate. Tax rate we are talking about for that particular country on how much taxes you actually pay on your profits which are generated by the business. Plus the depreciation and amortization, because as we all know, depreciation and amortization is actually a non-cash expense. So this value is added back in the free cash flows, minus any kind of a capital expenditure which the firm is doing, right? So because capital expenditure is an actual cash outflow, minus any changes which happen in the working capital, right? Because working capital is a continuous cash transactional methodology. So basically, there are cash inflows and there are cash outflows happening in working capital. So any changes in those working capital are also subtracted because it is assumed that there's a cash outlay which will go in the working capital requirement. Now, when I said that, the cash flows are discounted on weighted average cost of capital, this weighted average cost of capital is nothing but it is the blended cost of debt and equity. Now, when any firm is running, right, it is assumed that either the firm runs on the equity investments, which are either done by the founders or they are done by the investors. Obviously, you pay a return on the investment to be utilized. That becomes your cost of equity. And if in case a firm borrows money from the market on certain interest rate or coupon rate, that is called as the cost of debt. Now, how do we calculate the weighted average cost of capital? Weighted average cost of capital is nothing but the cost of equity into the amount of equity which you have utilized over the total value which you have utilized, combining both equity as well as debt, plus the cost of debt which you have utilized, at which you have taken the debt, I would rather say, into the total amount of debt which you have utilized, divided by the total value of equity and debt into 1 minus the tax rate. Tax rate, as I said earlier, it will depend on the country on which you're calculating the valuation. This way, you will be able to calculate your discounted cash flow, which will give you an exact value of valuation, what is expected out of the current business or the current asset which you're talking about. Now, there is a small variant in DCF, which is called as the capitalization of earnings. Now, this kind of a methodology is primarily used for mature and stable companies. Especially those companies which have a very long history of operating history, I would rather say, of cash generation, right? Over there, what happens is it is very easy to understand how the growth will happen. So the growth becomes more or less predictable. So what do we do in this methodology? Value is nothing, but it is the company's expected annual earnings divided by a capitalization rate. And capitalization rate is nothing but your discount rate, which you're using minus the long-term growth rate. And long-term growth rate in mature companies usually becomes more or less constant, which we have seen ideally to be varied between 3 to 5%. But again, as I said, it depends on country to country, depends on business to business and sector to sector, right? So again, I'm saying that capitalization is actually used for mature companies when the growth is stable, margins are normalized, and the business has a long-term operating history. Now, what are the other two methodologies which we are talking about apart from the income-based approach? The second is the market-based approach. Now, why and for whom are we trying to understand this market-based approach for? Market-based approach is specially utilized for the companies, right, where we are trying to compare them with certain peers in the market, because we may have some kind of a reference of similar set of businesses which are prevailing in the market. So let's understand what is market approach. It is nothing but the comparable company analysis. And in comparable company analysis, the top three parameters which are ideally used to understand and to find valuation in the market-based approach is nothing but EBITDA multiple. So EBITDA is your earnings before interest, taxes, and depreciation and amortization. Second is your price to equity multiple, right? Price of the share which you earn over the equity share value. Third is the EV by revenue. So it is the revenue multiple. So how do we actually do that? We select a peer of publicly traded companies, right? And whatever those companies are trading on, we apply those multiples to the target's financial metrics. So if let's say if you are trying to find about an X company, and that X company is still an unlisted company, what you try to do is you try to find out companies which are of similar business in nature, in a similar segment, right? Operating on, with the similar set of benchmarks in terms of revenue and margins, and especially on the trading and on the listed side, on companies which are actually getting traded. And you find the tradable values for those companies and you apply those multiples to that X company. You will try to get closer to the kind of valuation which that business is operating on. Now, what is a precedent transaction analysis? Now, more or less, there are also mergers and acquisitions which are happening. Now, in case of mergers and acquisitions, what happens? The shareholders who are actually willing to buy, right? They always buy at a certain control premium, because there is a certain payback period at which these investors are expecting that the amount of investment which they are actually doing on buying the equity or the company or the asset, they would want a return in certain period of time. Now, this kind of a methodology, it looks at historical M&A deals which are prevalent in that particular sector. And as I said, acquisitions require a certain control premium to convince the existing shareholders to sell. Precedent transactions typically yield a higher valuation range than the trading comparables, right? This whole thing forms the market-based approach. Now we are talking more from the asset-based approach. Now, what is asset-based approach? Now, we've seen the floor of valuation, which is, we are talking about two terminologies, which is the book value and the liquidation value. Now, book value is nothing, but it is your total assets minus your total liabilities. Is this methodology correct? Now, in certain cases, it might look like it is a very good valuation to go for. But then, this kind of a methodology, if it often understates the true worth of the company or the asset, because it is not able to, internally calculate the brand value which the company might have built in. So there is no valuation counted on the brand value. If the company has certain kind of an IP, it ignores the IP as well. If it is also generating any future cash flows, it ignores all the future cash flow generation capacity. So book value can only be assessed to a certain level. For example, sometimes what happens is there's a manufacturing firm, and this manufacturing firm now wants to sell a certain piece of an asset. Now, this asset, sometimes people try and buy it on a book value. But the best methodology to understand, or I would rather say, the best way to understand that is this methodology right or not, is to find the life of the asset. If we are talking about the of the asset is almost near, right, it will not be able to generate huge cash flows, and that it requires a lot of service, right, then there are very good chances that you may even sell it at a scrap value, right? Book value holds true only in cases when you do not know anything about the future generation capability, and you're still not aware on how that particular asset is going to perform. The second methodology which we are talking about is the liquidation value. And I think in my previous video, when I was talking about liquidation value, I already told you that the assets where the asset we term as a distress asset, or someone who is facing a lot of liabilities or crunch, or is not able to operate, such kind of assets are sold at very high discounted prices, which is called as the floor valuation or the liquidation value, right? Typically, no one would want to do that. And even if someone wants to do, or would probably want to do that for any physical asset, they would want to do it, considering it to be as the scrap value, which is the end life of the asset, right? Otherwise, people would definitely want to go ahead and ignore the liquidation value. So yeah, this is something which I think I've been able to try and give you some kind of a dope around what are the various methodologies of valuation.